Is there a certain country or company that you would say, needed to be downgraded a long time ago?
We talk about the US most of the time, so that's one. The governance structure is deteriorating, so the monetary flexibility is still there, but Donald Trump is also sowing on that branch on which the US rating is sitting, and the debt is totally out of control. I mean, if this was an emerging market country, the IMF would come in.
Welcome to You're in Business. I'm thrilled to say that we're going to get another perspective now with Moritz Kraemer. He's the chief economist and head of research at LBBW, one of Germany's most important banks. Moritz, what a time to debate markets and economies. Thank you for making it to the program.
Sure, thank you very much for having me, Josef.
I mean, let's get straight to the tariffs, because from Germany's point of view, it could not come at a worse time. How much damage is going to unfold, in your view, over the next few weeks and months?
Well, it couldn't have come at a worse time for anyone, really. I mean, the world economy has been slowing as it was, and this, of course, is economics 101 all in reverse. You do everything wrong pretty much on the US side. It's obvious that those countries like Germany, which are highly dependent on the export sector, are going to be hit more, and especially those that are dependent on trade in goods or manufactured goods or cars, because cars tends to be sort of one of the bear bugs of Donald Trump. Maybe because he can imagine the product very well. And we're, of course, a major car producer and exporter. So Germany, which has been in stagnation for over 2 years now, indeed didn't really need that this last sort of demand engine is going to be switched off by Donald Trump.
What kind of reforms are needed then to make Germany competitive in this new world of sort of deglobalization? Maybe is one way to look at it, right?
Yes. Well, I would sort of push back a little bit on the competitiveness issue, because in a way, clearly Germany is competitive. It has a large trade surplus. So something is right. But what it is not is innovative. So Germany has become the world market leader in the products of the 20th century. And we need to step up. So we need to have more investment on the public side, infrastructure, digitalization, on road, rail, all the rest of it that we all know, energy, transmission lines. But we also need more and better investment in the private sector. If you compare private sector investment, it is actually in Germany much more old style, like warehouses, trucks, machines, etc. There's relatively little intellectual property, IT related, compared to other countries. So that's one thing that we need to step up, is more investment. And the other one is we just need to work more. Now we have a demographic decline. We have at the same time, not only are we losing workers just for the demographic change and the aging of the society, about 500,000 per year net. That's a lot. That's like 1% of all employees in the country. But we also have an ever increasing rate of part-time work. So we need to invest more and we need to work more. You could say, it's a success. The Germans now decide they want to work less. And that's, in a way, fine, no? Because you don't want to live to work. You also want to work to live. And now they're living a little. But of course, then you have no growth.
Here's the thing, Moritz, because I've spoken to a few other economists and they've told me that they're not sure that the government has the right scale in terms of their ambitions to reform Germany, right? That the ideas are, in general, correct, but it just needed more more amplitude. Do you subscribe to that view?
I would. I mean, you're obviously referring to the hopefully new coalition, which is not done and dusted yet, but I would assume that Judge Merz will become chancellor quite soon. But it's indeed a tricky situation, because we as voters, we have been pretty mean by putting these two parties in bed with each other, and they're far from in love with each other. So you see compromises everywhere. And indeed, I think there's some good ideas in the coalition agreement, but the big reform agenda, on pensions, for example, or really on a clear pathway towards debureaucratization, that is still missing. And in particular, I don't think you have a credible financing plan for all those promises that have been made. So I can anticipate that this harmony that is now being demonstrated is going to be pretty fragile and crumbling next year at the latest.
But what about the Schuldenbremse? I mean, that's been kind of put to the side. Isn't that going to open up new avenues to sort of generate the right amount of liquidity to be able to access the financing that you're talking about? Or, is that not going to be enough? Plus, I think the infrastructure fund as well, which is around 500 billion euros.
Yeah, no, the infrastructure fund is what is needed indeed. And 500 billion is about the estimate of the decay in the capital stock in infrastructure in the last decade or so. So this is the right thing to do. I would have preferred to open the debt brake or Schuldenbremse, as you say, for investment and not for defense spending, because defense is really consumption. There's no revenue stream coming up. So this shouldn't be funded through debt. But, that's the decision that they took. But more importantly for the economy is the investment drive that we can expect now. And we need to build up capacity in the construction sector as well. But the construction sector now has 12 years sort of planning horizon. So I'm more confident that actually something will happen. People will complain about all those construction sites everywhere. That's predictable. But that's what's got to happen. And it's not only money, actually, Yusuf. You also have to simplify the processes, right? There's always money left in the investment budget of the government, but it's just too complicated, the planning, the permissions. So we got to get more agile on this as well. Money is important, but it's by itself, it's not going to solve the infrastructure problem.
Yeah, I mean, if you wanted the standard for, rapid entries of construction sites, that look no further than Dubai, because, here around every corner springs up a new ambitious either skyscraper or museum or hall or whatever it is. But in terms of...
I know, yeah. I mean, you do inauguration when we are still preparing the procurement process. That's exactly where we can learn.
But in terms of what kind of outcomes could be achieved from the discussions between the EU and the US, right, around tariffs, what would be a realistic result from what you can tell at the moment? Obviously, it's hard with Donald Trump in the White House, right, to make a firm call. But what would you say could be done and could be beneficial to both sides?
Well, the best hope is that Donald Trump sort of walks back the line a little bit, saying, I'm only going to accept deals which will eliminate the trade deficit of the United States. That's impossible. It's not going to happen, right? So he needs to completely block. So, but if, like in the first presidency, you can sort of mollify him by saying, okay, we're going to buy a little bit more LNG, we buy a little bit more corn and stuff like that, maybe peanut butter, whatever. But I think he has hardened. I don't think we get away so easily as we did in Trump 1.0. So I actually don't see the avenue. And I actually anticipate that Europe and others will be pressed into cutting ties with China as well. And that will create a huge disruption in world trade, and for Europe in particular, which is an open economy. So I'm not very hopeful, because we don't even know what the man wants. So what is actually the objective of those negotiations? It cannot realistically be to eliminate the trade deficit of the United States. That's not going to happen through. I mean, we cannot buy that much LNG and peanut butter. It's just not enough need for it.
I mean, that's quite a pessimistic take. So if that is sort of your base case, does that mean that it is more likely than not that Europe makes use of what some have described as the nuclear option, the imposition of a digital tax, which so far has been kind of a red line a little bit? If everything is up for grabs and there's going to be a true reset, then Europe should be, making use of that, a little bit more muscle in the game.
Yeah, we could go down that road and say, look, we have a deficit in the trade with services, and the digital services are a big part of that. So why don't we go down the same road. I think it's quite dangerous, though, because we cannot substitute those services. And if you enrage these people in Washington and they say, okay, then we basically ban the use of cloud services or whatever of US-based companies, what are we going to do? I mean, we're going to shoot ourselves into both feet. So I would recommend sort of the old saying, if they go low, we go high. But what is true, there are certain benefits that the tech bros have in Europe. For example, there's no value-added tax on advertisements on the platforms, etc. This is unfair, right? So this should be corrected. So they should be taxed properly, but not punitively.
I was looking at the relationship between China and Europe, and basically what stood out to me is that you had $104 billion of German exports to China in 2023. You're saying that they're going to be pressed to decouple from China. But let's say they try and sort of reaffirm that relationship. Is there an opportunity to strengthen relations with China if those with the US kind of continue to fade or break down or crumble? I know there are historic reasons for that not to happen, and it's not necessarily the most likely outcome. But there's a lot of things that weren't likely at the beginning of the Trump administration that turned out to happen and to turn out to be true. So maybe the EU getting closer into the China sphere of influence is more likely than we think.
Well, I don't really think that Europe is such a hopeless piece of driftwood, no, that it needs to latch on to either the US or China. I mean, this is sort of the largest market that the common market in the world still. But we need to trade. And I actually think the risk that we get into trouble with China is that China is now trying to redirect its exports, which can no longer go to the US, to Europe, which is the largest market. And we are not ready politically or economically to absorb all this stuff. And the Chinese need to export because the domestic demand situation is so weak for aging and over-indebtedness and housing crisis and so on. So I think we will get closer to Beijing in terms of coordinating. But we have a trade deficit with China. So in a way, this would balloon if we were to allow sort of redirection of trade. So it's much more complicated than that. And then there's the Taiwan and the geopolitical situation, the human rights situation. So I think they will try to keep an equidistance and keep fingers crossed that the show in Washington is going to be over sooner than many people think. And I think that's not all that unrealistic, actually. Remember, there are going to be midterm elections next year.
Do you still drive a German car, or have you switched to a Chinese EV?
I wish I could say I drive an American car to appease the president, but I'm driving a French car, actually.
Okay. All right. So
it's close enough.
Because once you switch, that's going to be the barometer for the rest of the system.
I'll let you know.
In terms of your pulse check on the global economy, like, would you say that we are already in a global recession? Just run us through what kind of numbers stick out to you.
Yes, I think so. My estimate for global growth this year is somewhere between 2.5 and a little plus maybe. Partly, I think the US is gonna grow much more slowly. There is no inclination to invest in this uncertainty. Consumption, we can see all the early warning indicators that the consumption demand, the American consumer, really, you could always rely on him, but this looks like it's weakening. And in China, the numbers, I mean, if the export machine is switched off, the numbers are not believable anyway. So when we publish the Chinese growth, we always sort of subtract almost a third of it because we don't think they're real. We don't think they grew at 5% last year. But, these are the only numbers available. But it's, Yusuf, show me a region in the world that is accelerating. Everyone is slowing down. Commodity exporters are having a harder time now as well. So everyone is slowing down, and it's to a large extent self-inflicted.
The market moves as well that we've seen in response to this policy shock from the United States is nothing short of historic. The move in U.S. 10-year yields since the U.S. president took office, in particular in the last 3 or 4 weeks, I would say, but also big moves in the German Bund. And I'm wondering, out of the two, which one is the real haven? Because it seems at the moment that people no longer believe that the U.S. government paper is as safe as as we all would like to believe, as economists would like to claim.
Yeah, and as it has been for decades. I mean, the U.S. Treasury bond has been the safe haven in all financial crises. I remember when in 2011, when I was part of S&P and we downgraded the United States sovereign rating, the U.S. bond rallied because times get more uncertain and you go into the bond that was just downgraded actually. But now the safe haven is being mined by President Trump. So what do you do if there's suddenly sort of all these mines floating around in the safe haven? So you're going to look for something else. And I guess, there's no other asset class which is similarly large that could play that. I mean, if you look at the US government bond, that's almost 40% of all government bonds in the world. Germany cannot absorb this. Switzerland cannot absorb this. It's just too small. Bitcoin cannot absorb it. So I think that this reluctance and this flight to the short end of the yield curve will continue unless there is more credibility reinstated. I mean, all this talk about the Fed chair is as unhelpful as it comes. And I think if I was Donald Trump, which thankfully I'm not, I would say, okay, look, for once, I make a couple of things clear. We're not going to do the Mar-a-Lago Accord idea, which is like expropriation of foreign creditors. And we're not going to meddle with the Fed's, independence. And I would this time refrain from making a post on Truth Social before I say that. But I think there are actually easy ways out to calm the markets. But it seems like the instinct is it's not going well, I'm doubling up. And that's pretty dangerous. And depending on how long this lasts, it will be difficult to rebuild the trust that is now being destroyed in the US as a safe and predictable currency area.
The dollar's presence in global reserve currencies. I mean, you're already saying this is not going to be substituted overnight, just because the amount you don't have the same scale of instruments that could absorb that kind of volume. But if you still would have to suggest ones that become more in favor, I mean, is it going to be? I mean, Bitcoin and the sort of Chinese renminbi. I mean, those would be very small actors, right? And sort of the global systemic kind of dynamic, right?
Yes. Well, this is a process that's been going on for 2 decades now, that the weight of the US dollar in international reserve holding is declining. And it's not at the benefit of the euro, and it's not at the benefit, or not very much, at the renminbi, because it's not even convertible. It doesn't really have the characteristics that you need of a reserve currency. Those currencies that have gained are actually sort of the Western currencies in the second row, like the Canadian, Australian, Swedish, Swiss, etc. So it's much more diversified, and I would expect this to accelerate. And China has been running down the share of dollar reserves for a decade now, and it would be utterly surprising if they would not continue or even accelerate this.
What do you make of what the European Central Bank has been doing in light of the market volatility? Would you say they're still on the right track?
I think they've done a fine job. I mean, it's, people complain about they've been too late in hiking interest rates, but I don't think it would have made a huge difference if they'd been like 3 or 6 months earlier. I think they've managed this really well, and they now have the room to cut rates further because inflation is actually moving towards target. It's very, very close. We see the driver is services, and services driven by wages, and wage growth is coming down in most countries. So it's going pretty well. They've done the right thing, and they will continue to cut.
I mean, you say that, but you look at a chart of sort of euro dollar, and the euro has rallied about 15% since January 30th, which is around the time President Trump was inaugurated. I mean, that's yet another weight that will be pulling down the ability of Europe to export competitively to the world. Those are not small numbers. If it stays at this range, or even strengthens more, it becomes a lot more expensive to buy European goods and services. Should the ECB get ahead of that?
Well, it's. I think they will continue to cut. I would expect by the end of the year we're at this deposit rate of 175. I mean, the appreciation of the dollar, I mean, of the euro is more like a depreciation of the dollar, right? So it's not. I mean, the US is an important partner in trade, but it's not the wherewithal. So we have other destinations where you didn't have that much of an appreciation, but it also reduces the inflation rate, right? Because you import and you also have lower commodity prices. So this gives the ECB plenty of space to cut more, and they will use it.
What would you do if you were the Fed chair, Jay Powell, right now, under pressure from the U.S. president, very public tweets and Truth Social announcements calling him a loser? Mr. Too Late. We don't really have precedent for that, so it's hard to kind of lean on lessons from the past.
Well, we have a president in the first Trump presidency. He did similar things. It's getting a little bit more vicious now. But I would recommend just stay the course. Don't be intimidated. There's too much hanging on it, and if you cut rates now, in an environment where we have a risk of rising inflation and you're just coming out of an inflation disaster, this would be hugely detrimental to the credibility of the Fed. And Donald Trump cannot just substitute him. We can talk about that. And even if he substitutes him next year, which he can because his term is going to run out, and if he puts, I don't know, Steve Bannon or someone there, this is not a one-man show. There's the whole college of governors. This is actually much harder to win over than the Supreme Court. So I think the Fed should do anything, however painful it is, to make sure that they are not playing this political game, that they are true and loyal to their mandate.
I mean, it looks like their hand might be forced, though, because if the economy continues to become more and more fragile and eventually just sort of begins to break, in earnest, then the Fed would have to move, right? I mean, whether or not the chair agrees, if the joblessness goes up and inflation stays up, the priority at some point becomes saving the economy rather than saving the currency.
Well, it's not that straightforward. I think, yes, they might have to move, but I'm not sure in which direction. Because if you really follow through on all these tariffs, the inflation rate will go up to 4, 5, 6% pretty quickly. I mean, if this really happens, which is not I think it will climb down to some extent. How can you cut rates without destroying any credibility? We're not in Turkey. I mean, I know that Donald Trump envisages monetary policy similar to President Erdogan in Ankara, but that didn't end well. I mean, look at the inflation episodes in Turkey. It's not going to be that bad in the US, I guess. But, it's one thing if it happens in Turkey. It's another thing if the most important financial institution in the world capital markets do something rash and foolish. So I'm not sure that the next rate will be down. I mean, it looks like this, but it depends all on what Donald Trump's going to decide on trade.
I want to lean on your experience at S&P, 17 years. You were basically one of the key individuals signing off on ratings decisions. And basically, I'm wondering what your view is of, where we are with credit quality today.
Oh, it has suffered a lot. If you look at leverage of governments, advanced economies, governments, if you look at growth potential, we analyzed sort of in the early noughties already, like what is the impact of aging? All this is now around the corner. And remarkably, we haven't seen almost no rating action at all on advanced economies in the last couple of years by the big three. The pandemic, did it happen? You wouldn't know it if you were just look at the ratings of advanced economies. Emerging markets, yes, they've been dishing out downgrades relatively generously. But I think there's a bit of a disconnect. So I don't think that the current ratings reflect the real risks.
Would you say that the ratings agencies are doing a better job today in being more agile and responding to some of the changes in circumstances? I mean, it's never going to be proper real time, right? Just that there's sort of always a natural lag. But obviously, it's sort of historically, the longer lags have proven to be disastrous, sort of in the last 30 years. But would you say today that things are, going at pace, or would you say that they're still quite late sometimes?
No, I think they're not agile. Actually, it's the opposite. I think they are just sitting on the ratings for too long. And I guess the experience that they made during the GFC and the downgrade of the US, that's pretty sobering. A euro crisis as well. So there is a certain reluctance. You need a thick skin. I know that because I was in there. You get sued even personally. And it's hard, no? But that's their job. And, if I think back to the US downgrade, 2011, this was the Obama administration. It was pretty rough. The reaction from Washington was not very kind, to put it mildly. Now, fast forward to Trump 2.0, just imagine all hell would break loose and you can lose your business. The SEC supervises the rating agencies, and the SEC is in the pocket of the White House. So if you downgrade the United States, it's a huge risk to your franchise.
Is there a certain country or company that you would say, needed to be downgraded a long time ago? Now that you look at it, is there something that stands out? It could be one of the bigger sovereigns.
Yeah, no, you have look at. We talk about the US most of the time, so that's one. The governance structure is deteriorating. So the monetary flexibility is still there, but Donald Trump is also sowing on that branch on which the US rating is sitting, and the debt is totally out of control. And it's actually quite easy to solve. You just need to tax your country properly, as other countries do as well. If they had the average sort of tax ratio of the G7, the US would run a huge deficit surplus on the budget, and that would also remove the deficit on the external side, or make it much smaller at least. If this was an emerging market country, the IMF would come in. There's no prices one for what they would recommend. Say, okay, you need to increase savings. And the first thing you do is you reduce the budget deficit. But the opposite is happening. And that's not a Republican thing. No, the Democrats have, added spending. The Republicans cut taxes. So the last government in the US that really made a credible effort was under Bill Clinton. And that's a quarter of a century ago.
So you would say that lessons have not been learned sufficiently then? From
they have not.
The financial crisis, sort of the global financial crisis, and then you're saying the Eurozone crisis as well. So the systemic risk is much larger today because of the greater scale of debt and leverage in the system, right? So
there's more debt, and there is less savings. No, as societies age, people move out of the high savings cohorts and go into retirement where you dissave. So the savings ratios will go down while the funding needs of governments will go up. So that's not a good position to be in. That means the interest rates will go up. And that would just heighten the pressure on budgets.
In terms of your upbringing and your background, you got the best possible grade, I understand, on a graduate degree in economics at Goethe University in Frankfurt, which is a 1.0 or 1,0, as we say in German. What is the one piece of mainstream economic theory that you've never been a big fan of to begin with?
Well, I would say probably while it's very compelling theoretically, it's the theory of rational expectations. I know why it makes sense to argue this way, but you look all around you and you don't see rational behavior in many areas. So what doesn't work on the micro level suddenly works on the macro level. I think that's a step too far.
And who inspired
we have one politician like Ludwig Erhard, who is very much still honored here in the country, in Germany, like the father of social market economy, and he quite rightly said that economic policy is 50% psychology, and that just shows it's not rationality. You got to move the spirit of the people and try to do this in the right way, and then investment can pick up, consumption can pick up. It's all about how you feel about things, and not people don't make macroeconomic calculations.
Do you think that sort of the impact of AI is being quantified well enough in economic theory, because it's such a rapidly developing field and so disruptive as well, that probably policymakers are a little bit behind the curve, whether in Germany or anywhere else? I mean, they're always trying to, it's always like, it's almost impossible to achieve.
Well, surely in Europe and in Germany, we're behind this because we have the tendency to see the risks first and then the opportunities later, which sort of rhymes with what I said earlier, that we are still investing in the old style, like warehouses, etc. The US innovates, the Chinese then produce it, and we regulate it, and that's not good enough. And I think we need to become more courageous, not mindlessly just accepting everything that comes along, but we need to take some risks, otherwise we're going to be left behind.
Who inspired you to get into economics?
Well, initially I actually wanted to study literature, and I did that actually for a while, but then I thought I better have a plan B, because I don't know where this avenue was going to lead, and I dropped the literature part and kept that as a hobby in a way. And I liked economics because it's somewhere at the crossroads of economy, politics, international relations. I always like the macro part most. And it gives you ample opportunities in all different areas. So I never regretted it. I recommend it. Study economics.
No, I never thought I'd hear anybody say that. In terms of what you would, what guiding principle do you use to motivate your team?
Well, I think the most important thing is that you stay true to yourself. It's very hard sometimes, depending on which area you work in. But if you're an analyst, if you work in research or in ratings, you got to speak your mind. You may be wrong, but don't self-censor yourself. And that's the most important thing, I believe. So if you start to second guess what will some people think or say about what I do or write, you already lost the plot. I mean, for example, the downgrade of the United States, you couldn't have done that. Of course, we anticipated there would be trouble down the road, but we thought it was the right thing at the time. So what I tell my people, you don't have to write and say everything you think, but never say or write anything that you don't think. And that you're in the clear.
One other aspect that we talk about on this program is how basically people approach investing from a personal point of view. So not just what they're doing, from an institutional angle, managing assets or advising on assets, but what people are doing with the money that, they get through their paychecks or that they've earned through entrepreneurship. So in your case, I mean, are you the kind of guy who likes sort of high sort of cash savings account with high yield, or, are you more adventurous and you go into, some of the frontier markets and government bonds? Run us through what your portfolio looks like to the extent that you're able to share.
Yes, no, I don't do stock picking, partly because I'm not allowed to. But I actually have a pretty sizable short position still on the stock market.
Oh, wow. Okay.
But having said that, I don't invite you to follow me, because my first investment, which I sort of remember, it was sort of traumatic, was during the dot-com bubble, where, again, this is the risk when you think you're smarter than everyone else, which sometimes every investor does. So I was going, so this is ridiculous what's going on. So I started to short those stocks. And of course I was right. I was just too early. So so basically I lost a lot of money on the way. And when the bubble popped, so I was out of the money already. So it's trying to time the market is actually something I would not recommend anyone to do, but unfortunately I can't resist myself.
Yeah, I keep hearing that. There's like every time it's like, don't time the market, just dollar cost average, just put it in the market and, you go on with your life. But then the reality is different. It's like, yeah, I'm going to try. I think I've got the edge. I think I've got a few gifted ideas. There is arbitrage to be secured. What about the 60-40 portfolio, right? So I was listening to Larry Fink, CEO of BlackRock, and he's saying that it is no longer a representation of true diversification. Given what we've talked about in terms of credibility of government bonds, do you is that something you concur with? And if we take the bonds out, what would we replace it with? Is it going to be gold, Bitcoin?
I still think it's a good overall balance between fixed income and equities. But the correlation can be pretty high at times, and right now it is, especially in some segments of the bond market. But crypto or gold, it's just not big enough. I mean, what we're seeing in the gold market right now, fundamentally, the gold market is overbought. But what you cannot measure is, again, rational expectations. Criticism here is the fear factor that people just try to dig into something that they think will survive whatever's going to happen next, and therefore, I would still think this is a good. I mean, you've got to invest in something, and you can. What else is there? You could do real estate, but that's of course also hit by demographic changes. That's hit by interest rates and so on, and there is a lot of leverage. So the easy gains, I think, are off the tables, and the next couple of years considering where we are right now. I would think that we get pretty meager returns on equity. Because most of the good news have already been consumed. I don't predict a sort of a crash or Black Friday or something like that. But the easy part is over, where everyone could turn around and say, I'm a financial genius, because everything, the rising tide lifted all boats. So it's got to get much more selective.
Yeah, I mean, you look at the sell-off that is underway and how much sort of equities have already come down. And you always, of course, think, should you start nibbling? And a lot of people do. And I've considered a few trades as well. But you never want to be the person catching a falling knife, especially with what we're hearing on, the U.S. administration side. A couple more questions. One is, who is or was Germany's greatest politician since the reunification?
Oh my God, who might that have been? Well, it's a pretty summary statement if I say one or the other. I would give. The longest serving politician we had at the time was Angela Merkel, of course, as a chancellor. So I think there are lots of criticisms being aired lately, and some of it rightly. This was a period of stasis. As the country was just trundling along in a comfort zone. It didn't innovate. It didn't move with the times. But what she did really well is, in the end, how the Euro crisis got resolved. And I just sometimes think, what would have happened if last year we had a Euro crisis like this, and we have in France and Macron with the back to the wall, and in Germany Scholz, who doesn't seem to be very interested in European issues at all. So I think she was one who showed leadership when it was really necessary. Unfortunately, she didn't show very much leadership when it was when you could avoid it. So that's something I have respect for, with all the criticism. I don't really know. Somehow people always say that, but politicians were better in the past. Well, I thought I was hoping you give me a longer time frame that I can hark back to people like Helmut Schmidt or so. But
well, that's why exactly. That's why I put the I tried to make it a little bit more difficult by kind of narrowing the time frame. What's your morning routine like? How do you get your energy level up to speed and your focus kind of where you want it to be?
Well, I start with sleeping very well, actually, and I'm very grateful for that. I don't know whether that's just a gift or an expression of exhaustion. I don't know, but so I wake up relatively with a high energy level. I don't have breakfast, which saves me some time, but also I think once you get used to it, you create more energy internally, I believe, and I just. don't get too wound up about things that await me during that day. So I hope you wouldn't say I come unprepared to anything I do. I don't get the impression here, but it's once you've have a couple of decades really of professional life under the belt, so you become a little bit more calm, right? So it's I've done everything. This day is going to go well as well. So just don't get nervous, don't get excited, and then you can harvest your energy a lot.
Coffee or tea or none of the two in the morning?
Coffee.
Okay. How do you have your coffee?
Black.
Okay.
In the morning.
Closing question. When was the first time you visited the Middle East, and sort of what keeps you from coming here more often?
When was the first time? It was probably in the mid-noughties or so, when we at S&P opened the Dubai office at the time. So I've actually been to all GCC countries. So our bank is doing some business in the Gulf. Unfortunately, not as much as they could. I would have been in Riyadh in February for a speak at a conference if it hadn't been for a conflict of engagements. I've been there last year, so I tried to come at least once a year. So, Yusuf, you give me a good excuse to come.
Yeah, now you do. Now, because we're overdue for a catch up in person, so we can agree to meet in another 2 or 3 months, and probably the world would have changed again by then. So there'll be plenty to debate. So thanks a lot for your time.
Sounds like a
that's
plan.
Moritz Kraemer there, who's the chief economist at LBBW, one of Germany's important banks. Thanks again for your time.
Thank you, Yusuf.
If you enjoyed that conversation, don't forget to like and subscribe. We've got plenty more insightful talks on the way. We cover business, finance, and everything in between.